Good morning. Thank you, Mark and Lauren, for coming into my office today. As you know, we've been in discussion with regards to your financial plan over the past few months. Uh, there's a few things I'd like to discuss with your financial situation and some of your goals and how we can really best meet some of your goals and expectations. Uh, but before we begin, I really would be remiss if I didn't mention a few things. So the detail really provided here within this financial planning document is meant to be educational. It really isn't intended to be interpreted as specific legal, accounting, tax, or other professional related advice or services. So should you wish to receive specific legal, accounting, tax, or any of these other services that you can possibly think of, please consult with a professional in that specific area of expertise. But I'm here to help you. Please stop me at any time throughout my presentation, and I'd be happy to answer any questions. Second, it is imperative to note that all of the financial illustrations that are also provided within this document, they're hypothetical in nature. While they're meant to be as fine-tuned to the point as possible, past investment performance shouldn't be interpreted as an indication for future performance. With that, I do want to begin because I do know that we have a short time. You don't have time to go through the entire financial planning document, but I do want to speak about a couple of your issues. And as we go through this, I want to reiterate what your goals were and some of your worries. And please stop me again and let me know if I was not correct in my original thoughts here. So without any further ado, I do want to hop right in and cover your the educational goals. You had mentioned that you, both Mark and Lauren, you have a daughter, Mary, who's now 5, and you had a goal to provide for her private education funding for her 4 years of undergraduate school and also 2 years of graduate school. So within some of the financial calculations that I've had, the goal to provide $40,000 in today's dollars for 4 years. This through assuming a 10% rate of return and a 7% educational inflation rate over time. This does require yearly savings at the end of each year. Good news is she's 5 years old. We don't expect her to go to school until she's 18. So we do have some time to save, and I do want to talk about some vehicles in a little bit about how we can best accomplish that. And so first, before we dive right into it, you had also mentioned, Lauren, you have a daughter from a previous marriage, Beverly. She has 2 children who are Mary's age as well. And you guys wanted to discuss really some of the, possibilities for possibly funding their college education as well, and maybe some vehicles that best help you reach that goal. So what I first did was, you have roughly 13 years to save, as I mentioned. So if you fund Mary's 6 years of schooling, we don't need to go into the calculation right now, but it would require approximately $22,652 per year. Putting that away, whether that's through a growth mutual fund or through another investment vehicle. And as you mentioned, you said how much would we have to put away each year if we wanted to fund not only Mary's private education, but also undergraduate schooling for both of Beverly's children. I estimate that you would have to put away roughly $53,681 per year over the next 13 years. And yes, I do agree, after going through much of your financial statements that you are in stable financial shape. But this is a big hunk of change to put away every single year. But there are some investment vehicles that we can use that will help us reach these goals. First, I think that I recommend establishing a 529 plan for each child. The 529 plan is a tax deferred and also provides for tax-free withdrawals if used for qualified educational expenses. And as our main goal is to provide for the 3 children's education, this is perfect. Many states with college saving plans, such as the 529 plan, allow for contribution limits in excess of $200,000. So this would also allow you, within this investment vehicle, to make contributions of up to $140,000 to each child without incurring a federal gift tax. But with more information on this, Again, I am not a tax advisor. I please would ask that you consult with your tax advisor for more information on the federal gift tax exclusion. So with that, I think we covered, in high-level detail, how much it would really cost to put away for the children. And the last point I want to touch on, Mark, you mentioned that you would like to sell Lake Enterprises and retire within the year, but you're uncertain of its current value. So the value shown on the statement of financial position is an estimate that you made several years ago. So with that, I went back and I made another calculation to kind of look at the terminal value. So we decided that, based on the stable earnings of your company, we would use last year's earnings and a discount rate of equal to 13% in order to come up with a current valuation. And what I did was I divided the forecasted net operating income for the year and assumed that 13% discount rate and arrived at the terminal value of $3,461,538. So with that, you see that with your original tax basis, you've grown your company exponentially. The original tax basis was $25,000. So an outright sale would result in a taxable gain of approximately $3,206,538. I do again recommend discussing some of the ramifications of an outright sale of the business in greater detail with your tax advisor. Lastly, a couple of things that will result from this sale. So we have a lot of opportunity with some new cash. So we have in excess of $3 million of cash coming our way. So really, what to do with it? I think that what we can do is we can set up that initial asset allocation that would help both you and Lauren create that new portfolio focused on providing for your retirement income, in which we would allocate 10% to aggressive stocks, 20% to growth stocks, 20% to S&P 500 stocks, 35% to bonds, and 15% to T-bills. You also had a profit sharing plan under Lake Enterprises. It is my recommendation that you roll this over to your IRA. This is in order to continue to take advantage of the tax-deferred growth benefits of an IRA over the next 5.5 years. As you are at age 65, I believe it's in your best interest not to take any distributions from this IRA until you must take required minimum distributions at age 70.5. So with that, Mark and Lauren, I believe you're in extremely good financial shape, but there are a couple of recommendations as we go through here that we could really make this financial plan a little more sound. But with that, I do want to schedule a second meeting. Hopefully we could sit down. There's a couple of other minor tweaks that I would like to discuss. But thank you again for coming in, and I really do look forward to further fostering our relationship and helping you reach your financial goals. Thanks for coming in, everyone.